Good evening, everyone. I'm delighted to be back in Auckland with my first class team. I can't see you, but I've got Mike Ross, Michael Goldsman and Sean Lee. So be sure to have a chat to those after our presentations. Today I'm going to talk about why we remain the lucky country. And you see, it's our economic structure. We've got very robust population growth. We've got an abundance of natural resources. We have a very stable financial system. And we've got a very flexible labour force. And that continues to provide us with long-term structural advantages. And it's a place that actually provides equity investors both resilience and growth. And that's something I want to unpack today. So let's set the scene with the macro picture. We've got GDP growth expectations of 1.8%, or we've just delivered 1.8, and expected to do 2.2% over the next 12 months. That's very robust. We've got a very resilient labour force. In fact, our unemployment rate of 4.3% hides participation rate, which is at almost record highs. And why that's important is that the consumer is coming into this part of the cycle with a robust wage and a propensity to spend. We do have inflation moderating, even though today's print was a bit higher than what the RBA had expected, but it is trending back down to that 2 to 3% range that the RBA has set as a target. Why that's important for equities in particular is it creates stability from an interest rate perspective, and it removes one of the biggest headwinds that equity valuations have faced. We're also starting to see some good results and numbers coming out from capital expenditure. So private CapEx, not government, is starting to accelerate. So that means companies are looking ahead, reinvesting, which should lead to productivity and, importantly for us, earnings growth down the path. Now, it's not on this chart, but it would be remiss of me not to talk about government debt. We are running a government surplus, or balanced, and in fact, our GDP, our gross debt to GDP is 33%. And that compares to about 110% for other developed countries. And what it provides is policyholders a lot of flexibility, and that gives us investors a reassuring aspect. So when you bring that together, you see an economy that is resilient and has real capacity for growth. And that's a very strong foundation for equity markets. So let's turn to equity markets. We have had an exceptional year from a performance perspective. But when I step back and I look at the broader market, there's been 4 key themes that have really driven market behaviours. First is tariffs. The dislocation of trade, predominantly between the US and China, has actually indirectly benefited part of our market, in particular critical minerals, rare earths, for example. Gold. Mike mentioned gold, but it's particularly important for our market. And that's because about 15% of our index are gold companies. And if you include those that service the industry, it's closer to 20 or 25%. So it matters. Technology and AI, we do not have the depth of tech companies that the US does, but the ones that we do have seen a huge amount of capital flows. And finally, defence. Defence budgets globally are going up. And there's a number of companies in our market that have leverage to multi-year procurement cycles. But here's the interesting point. All our Australasian equity funds have been underweight each of these themes. Yet we've been able to deliver exceptional returns, anywhere between 20 to 45% over the last 12 months for our clients, depending on what fund you're invested in. And that's an outcome of disciplined stock selection. It's not chasing theme of the month. And it's also a reminder that this level of return, that fundamentals still matter. And they matter most in the part of the market where we're actively investing, and that's the small and mid-cap part. It's also the part of the market that we see the greatest forward-looking opportunity over the next 12 months. And I wanted to frame that as to why. What we have here on this slide is the most recent performance from the small ordinaries from 2023 to current in green. And the past cycle, bull cycle for small caps, which was from 2003 to 2008. And what you can see is that we still have a way to run. And in fact, when I think about the conditions that really enable small companies to perform, they're in play now. So we have lowering and stable interest rates, which benefit small and growth-oriented companies more so. We have a broadening out of the economic recovery, and that benefits domestic cyclicals. And we've also got consumer confidence back on. So for the first time in 4 years, the consumer confidence index has stepped above 100. So when you put these ingredients together, and past evidence suggests that we are still more mid-cycle rather than late cycle for small companies. And that's why we remain constructive this part of the market. Right, I wanted to step back from the bigger picture and provide some stock examples and hopefully bring to life our process. The first is Monadelphous. Now, Monadelphous is a contractor and they service the resources, energy and renewable infrastructure space. They are cyclical, but they are also a quality operator. So what you can see here on the slide is a number of tier 1 customers, the likes of BHP, Rio, Chevron, Woodside. Monadelphous supports these customers through cycles. They also have a management team that have executed really well. They have created a lot of value organically and through value accretive bolt-on acquisitions, whilst maintaining a pristine balance sheet with net cash. Now, if I think about the earnings of this business, 50% are actually very stable, recurring in long-term contracts, growing at GDP percent plus. The other 50%, roughly, are a lot more cyclical. They're the engineering construction phase part, and this is the part of the business that we think is in an upcycle. So what you can see here in green is the share price chart of Monadelphous over the last 12 months, which is broadly when we initiated this company in Growth 2 portfolios and also held in KiwiSaver. But I don't put it up here to show that it's doubled over that period. I put it up here, most importantly, is the blue and the orange lines, which are earnings expectations for this year and next. And what you can see is they have been upgraded consistently throughout the last 12 months. So this is an example of a company that can generate very strong returns, an old world cyclical company at the right time of the cycle. Now, the other end of the spectrum, we have Life360. This is a compounder. Life360, just for those that don't know the business, is a family safety and location tracking app. About 75% of the revenues of this business is currently being generated by subscribers to the app, and they've been growing revenues about 50% per annum for the last 3 years. Earnings are accelerating as operating leverage kicks in. But the real value for this business actually sits with the very location-specific data that they're collecting on 92 million users globally. That data is exceptionally valuable to companies that want to direct their advertising to specific customers, like Uber. It also presents a really large opportunity for Life360 for future revenue growth. Now, in addition to the advertising platform, they've recently launched a pet GPS tracker, and over the next 24 months, they're going to provide for elderly family members too. So there are a lot of monetisation levers that this company can pull. And it's a real example of a company that is high growth, it can scale globally, and can compound over many years. So two very different companies, one old school cyclical, one new world compounder, but very good examples of the type of high quality opportunities that we're seeking for our funds. So let's wrap this up. Very quickly, hopefully you can understand the resilience and the dynamic nature of the Australian economy. You have an understanding of the companies that we're exposed to. They are posed for the next growth phase, which is broadening out away from those thematics that I spoke to. We do believe active investment is very important, particularly in the less efficient part of the market, like small and mid caps. And our goal is very simple, and that's to continue to outperform over a cycle. And we're going to do that by remaining disciplined on our investment and our investment process, which is being built around company fundamentals. So with that, thank you, and I'll pass to Mike.
Thanks, Michelle. I'm going to have just one question for you tonight because we are a little bit short on time. But before I do that, can I ask the Australasian team to stand up, wherever they are? In the back row, look at that. Mike Ross, Michael Goldsman and Sean Lee. I just wanted to say kind of publicly that these guys have done a fantastic job with the funds this year. It's really outstanding performance that you can have a fund that has delivered 45% over the last 12 months. And they have worked tirelessly over that period. But the question I've got actually about the performance is we've got one of your funds that's delivered 20 and one has delivered 45. So just in itself, it's quite a big difference. Could you explain that?
Sure. Yes, so I would like to say that the broader market delivered 5. So let's put things into context. But you're right. So Growth 1, which is managed by Michael Goldsman, we've had, I'd call out 2 things. Firstly is the part of the market that company is investing in. We've seen quite a bit of liquidity come into the market in a risk-on environment, which benefits the micro, small cap part of the market more so, and that's indifferentiated. But that's not actually the biggest driver. The biggest driver has been stock selection. So we've had a number of companies in that fund at quite material positions that have done exceptionally well, probably better than we expected them to in a short period of time. And just to provide some examples, like Plenty is a stock that was a big position in that fund. No one was looking at this company 12 months ago. Michael was, and it was at an inflection point from an earnings perspective. One of the companies got taken out at 120% premium, which was actually a case study 2 years ago for Pi. So again, just being very disciplined and patient around valuations and realisation of value in companies.
Great. Okay.
Yeah.
Thank you, Michelle.
Cheers. Thank you.